I have lived long enough to watch investors get hypnotized by the same kind of noise over and over again. The names change, the headlines change, the war is different, the commodity is different, the election is different, the technology is different, but the underlying mistake is usually the same. People let urgency replace judgment. They wake up to oil prices, interest rate chatter, labor market data, geopolitical shock, television arguments, and a fresh batch of confident forecasts. By the time they are done absorbing all of that, they no longer see businesses. They see symbols. They see fear. They see momentum. They see whatever story the market is shouting the loudest that day. That is usually when the real opportunity begins. I have never believed that the market offers its best bargains when the crowd feels calm and intellectually elegant. The crowd usually pays up for comfort. It pays up for certainty. It pays up when a company feels obvious, clean, and universally admired. The harder money is often made when a business remains excellent, but the narrative around it gets muddy, noisy, or temporarily unpleasant. That is the setup I see here. There are moments when an entire basket of high-quality companies get sold down together, not because every business has suddenly become bad, but because the market has moved from admiration to suspicion. Once that shift begins, it does not stop neatly. It spills. It overshoots. It takes companies with very different economics and very different risks and drops them into the same penalty box. Investors begin using broad language. Software is broken. Data is commoditized. AI will replace this. Competition will kill that. Rates will stay high. Oil will spike. Consumers will weaken. The language gets bigger and bigger, while the actual businesses are often much more specific and much sturdier. When I see that happen, I slow down. I do not ask which ticker has been punished the most in a week. I ask a more durable question. What is the actual machine here? What does it do? How deeply is it embedded? What would it take to dislodge it? What is fear getting right? What is fear getting wrong? And most important of all, what am I paying now compared with what the business is likely to earn over time? That way of looking at the world keeps me from getting trapped by the daily theater. Take FICO. A lot of people think of it as a score, a formula, a brand that happens to sit on top of consumer lending. That is too shallow. What matters with a business like FICO is not simply that it has a good product. Plenty of companies have good products. What matters is that it has become a language. That is a very different kind of moat, when lenders, banks, underwriters, and institutions all use the same framework to describe creditworthiness. The framework itself gains power beyond its technical merits. It becomes coordination, it becomes habit, it becomes process, it becomes the thing everyone else expects everyone else to be using. And once that happens, a challenger is not merely trying to build something cheaper or smarter. It is trying to persuade an entire ecosystem to change its shared language at the same time. That is a very expensive hill to climb. The market knows this, but markets do not stay rational in a straight line. FICO ran hard. It traded at a high valuation. It got the kind of premium investors assigned to businesses they believe are close to untouchable. Then the cycle turned. Guidance came in a bit softer than people expected. The company signaled that pricing would not be squeezed quite as aggressively as some analysts hoped. Competition began to receive more attention. VantageScore and the credit bureaus started sounding like a more serious headline risk. Software and financial technology were already under pressure. Suddenly, a company that the market had treated like an elite asset started getting handled like a vulnerable one. That is how you get a great business cut down by roughly half from a prior high. Now, if you are sloppy, you look at that drop and tell yourself a dramatic story. The moat is broken, the party is over. The language has changed. But if you are patient enough to look at the business beneath the price chart, a different picture appears. The concerns are not imaginary. Competition matters. Valuation mattered. Growth expectations needed to cool. But the system has not been rewired overnight. FICO remains deeply embedded in mortgage origination, lending workflows, and the practical vocabulary of credit. Even if something technically superior appears, superiority alone is not enough. Plenty of better ideas lose to the idea already in use. That is one of the most important lessons in business. The best product does not always win. The product that people are already organized around often wins. So when fear compresses the valuation of a company like FICO from a heroic level back toward a more normal one, I pay attention. I do not need the market to believe it is invincible. Again, I only need the business to remain durable enough that the market eventually realizes it has punished it too severely. Uber tells a different story, but it rhymes with the same principle. For years, investors looked at Uber through one of two extreme lenses. In one lens, it was a chaotic, low-quality platform business that would never earn durable money. In the other lens, it was a revolutionary network that would dominate transportation and logistics around the globe. Markets like extreme stories because extreme stories are easy to trade. Reality is usually more gradual. It usually arrives through operating leverage, better capital discipline, better execution, and a management team that proves it can turn scale into cash instead of turning scale into excuses. That is what makes the recent weakness in Uber interesting to me. When a company climbs to around $100 a share and then falls back into the mid-70s, investors do not need a perfect reason. They just need enough uncertainty to go from enthusiasm to hesitation. They start worrying about robotaxis, autonomous disruption, margin durability, competition, or whether the growth is about to slow right as the stock had finally won market confidence. If a stock has already had a big run, people become eager to believe the bear case because they know there is room for the valuation to come down. But the valuation has now come down that matters. A business generating this kind of cash, with this kind of global network, with this kind of operating leverage, should not be analyzed as though it were still a hope certificate. It is no longer the same Uber that spent years begging the market to believe profitability was possible. It has scale, it has a stronger balance between growth and discipline, it has a clearer path to cash generation, it has a management team that large investors have spent real time studying. When a man like Bill Ackman makes a position of serious size and calls a company misunderstood and undervalued, I pay attention not because famous investors are infallible, but because they tend to do the work before they make a business. One of their largest holdings, the specific fear hanging over Uber, is that the future arrives and the platform gets disintermediated. What if the cars drive themselves? What if the network loses its value? What if the transportation layer becomes cheaper and more commoditized? That fear is not useless. It is worth examining. But people often jump from technological possibility to economic inevitability without doing the hard work in between. They assume that because something may exist, it will instantly swallow the incumbent. That is not how most business transitions happen. Distribution matters, customer habit matters, logistics matter, market presence matters, regulatory friction matters, brand and trust matter, local execution matters. A platform that already organizes demand and supply at global scale is not a trivial thing to replace. That does not mean Uber will face no competition. It means competition has to clear a much higher bar than a headline suggests. When a company like that moves into a much more reasonable valuation range, I do not treat it as a trade. I treat it as the kind of business the market may have temporarily downgraded because it is nervous about what technology might do one day. Intuit is another place where fear is moving faster than business reality. This one is especially revealing because the market loves to tell itself that software can be obliterated by the next software tool. That sounds sophisticated. It sounds forward-looking. It sounds like the kind of sentence people say right before they congratulate themselves for understanding the future. But the future has a habit of being less elegant than the slide deck. Taxes are not entertainment. They are not a game. For most people, they are not a hobby. They are a thing to get right and get done. That seems obvious, but it is the foundation of the whole argument. A lot of the anxiety around Intuit comes from the belief that general-purpose AI tools will make products like TurboTax unnecessary. Why click through a guided system when a language model can read your documents and answer questions? Why pay for a structured tax platform if the machine can do it conversationally? Again, it sounds compelling until you remember how ordinary people actually behave. Most people do not want to tinker. They do not want to wonder whether a prompt was phrased correctly. They do not want to paste documents into a system and hope they interpreted a rule the right way. They want convenience, they want confidence, they want a process that is guided, fast, standardized, and attached to a product whose entire reason for existing is to handle this exact problem. That is not trivial. Convenience is a moat when the task is unpleasant. Trust is a moat when the task has consequences. And habit is a moat when the alternative requires more effort than the user wants to spend. That does not mean Intuit gets a free pass. The multiple was high. Expectations were high. The broader software group is under pressure. Investors have become much less willing to award premium valuations to businesses they once viewed as near monopolistic compounding machines. So the stock is being repriced not only for possible AI risk, but for a change in how the market values quality software altogether. That is how you end up with a company posting strong fundamentals, while the stock behaves as if it has already been convicted. I have seen that pattern many times. The market does not merely price facts. It prices mood. And when mood swings from admiration to doubt, the stock can travel a very long distance even while the business remains fundamentally healthy. If the core franchise keeps growing, if AI becomes more of an enhancement than a destroyer, if the retention and product strength remain solid, then the market will eventually remember what it used to like here. But by then, of course, the price will not be offering the same opportunity. Microsoft is a different class of case because it begins from a place of extraordinary strength. This is one of the very few businesses on earth that investors have long treated as bulletproof. A company does not earn that status lightly. It earns it through decades of relevance, enormous distribution, enterprise entrenchment, switching cost, recurring relationships, and an ability to sit in the center of productivity infrastructure for the corporate world. When a business like that gets marked down hard, you need to ask why. Not because the market is always wrong, but because the market does not usually hand you a better entry point into a franchise like Microsoft without demanding that you live through some discomfort first. The discomfort in this case is understandable. Valuation had become generous. Capital spending is massive. The company is investing at extraordinary scale in AI infrastructure and power requirements. Investors are rightly asking what returns will come from all of that spending and how long the investment cycle runs before the economics become more visible. On top of that, the relationship with OpenAI, once viewed almost entirely as a positive halo, now creates its own anxieties. Concentration worries people. Dependency worries people. Investors do not like the feeling that one of the great software businesses in the world is moving toward a more capital-intensive profile, right as the industry is entering an arms race. That is a real debate. There is a large difference between a real debate and a broken business. Microsoft remains broad, deeply embedded, and operationally strong. Its segments continue to grow. Its backlog continues to grow. The company is not being sold because it stopped mattering. It is being sold because investors are trying to reconcile a great business with a new wave of spending, a new wave of expectations, and a new set of uncertainties about how AI economics settle out. If you can buy Microsoft closer to fair value instead of paying a heroic premium, that is not a reason to complain. It is exactly the kind of circumstance I wait for. The market often acts as though every concern must be resolved before a purchase can make sense. That is backwards. If every concern were resolved, the valuation would already reflect that comfort. You are usually paid for bearing uncertainty, not for purchasing perfection. Brookfield belongs in this conversation because it reminds me how often investors confuse cyclical pressure with structural impairment. This is a different type of business altogether. It is not being dragged down by the software panic. It is not being hit because someone thinks a chatbot will eat its margins. it is being treated as a macro casualty. Higher for longer rates, oil volatility, inflation fears, and broad economic uncertainty make people nervous about anything tied to capital intensity, financing conditions, or long-dated asset values. When the macro fog thickens, investors become less patient with structures they already find somewhat complicated. That is what creates the opening. A business like Brookfield is not a one-quarter sentiment machine. It is built around the patient allocation of capital into large assets, long-duration opportunities, and businesses that can compound value across time if managed well. The market hates complexity when it is scared. It discounts it aggressively. It assumes the worst transmission mechanism from rates, commodity shocks, or inflation into valuation. Sometimes those fears are justified. Sometimes they are simply the market's way of demanding a wider margin of safety because it dislikes uncertainty. That distinction matters. If the fears are cyclical, then the damage to the stock can exceed the damage to the business. If oil spikes and then settles, if inflation anxiety rises and then cools, if rates eventually normalize or even merely become more predictable, then the market can revalue the same business very differently without Brookfield itself having to become a different company. I have always liked situations where the core franchise is still sound, but the market is temporarily pricing macro stress as though it were a permanent sentence. Then there is SP Global, which may be one of the clearest examples of investors confusing the existence of AI with the automatic destruction of every information franchise. High-quality data, ratings, benchmarks, and structured research businesses often look invincible until the market suddenly decides data has become a commodity. Once that thought takes hold, investors begin speaking as though every proprietary advantage evaporates the moment a language model can summarize documents or generate analysis. But raw access to information is not the same thing as trusted integration into market infrastructure. That is the difference people miss. SP Global matters not only because it knows things, but because the financial world is organized around what it produces, how it classifies, how it measures, and how participants coordinate around that output. Trust standardization, reputation, and embedded workflow all matter. Just as with FICO, a large part of the moat is not simply information. It is the market's decision to keep using the same common frame. The stock has been punished because investors fear AI will commoditize data, and because the whole quality software and information complex has been pushed into the same suspicion bucket, yet management itself is buying back stock more aggressively. That does not prove the market is wrong, but it tells you something important. The people closest to the economics of the business believe their own stock is offering value. They are not retreating, they are leaning in. That is worth noting when a company with a strong moat, high cash generation, and shareholder-friendly capital allocation gets revalued down toward historically much more reasonable levels. I do not dismiss that. I assume the market is giving me a chance to buy a better business at a more sensible price because it is afraid of what the future might look like. Now, when I step back from all of these cases, what I see is not a random shopping list. I see the market doing what it always does in anxious periods. It stops discriminating well enough. It begins lumping together businesses that deserve separate thought. It prices some real risk, then it adds narrative risk on top of real risk, and then it lets broad mood do the rest. That is where patience earns its keep. FICO is about language, credit, infrastructure, and whether the moat is narrower than once believed. Uber is about platform durability, operating leverage, and whether the market is underestimating how much network and distribution matter. Intuit is about whether convenience, trust, and embedded tax workflows can hold up in an AI world. Microsoft is about how to value one of the world's best franchises when it enters a huge capital spending cycle. Brookfield is about whether macro fear is overwhelming the value of patient capital allocation. SP Global is about whether AI changes the role of information businesses enough to impair a deeply embedded franchise, different businesses, different risks. But one common pattern, the market has moved from admiration to suspicion, faster than the underlying franchises have moved from strength to weakness. That is the whole game. If you wait for admiration to return before you buy, you will almost always pay more. If you are willing to do the harder thing, which is to sit with unresolved concern while judging the actual business instead of the prevailing mood, then you occasionally get to own exceptional companies during moments when the crowd is treating them as though something essential has already broken. That is where discipline matters more than brilliance. I do not need to predict the exact quarter when sentiment turns. I do not need to know which headline finally reassures the market. I only need to know whether the businesses are still likely to be larger, more entrenched, and more cash generative 5 years from now than they are today. If the answer is yes, and the price is now more favorable because other people are overwhelmed by current noise, then that is enough to get my attention. This is also why I do not spend much time letting market punditry run my portfolio. Every cycle produces confident forecasts that sound impressive on television. A strategist says the market will rally first and then fall into a bear market later in the year. Another commentator tells you higher oil and higher rates are somehow good for stocks. These arguments are often clever enough to be memorable and vague enough to be unaccountable. They create the feeling that if you just follow the right macro narrator closely enough, you can dance in and out of risk with precision. I have never found that to be a reliable way to build wealth. The stock market is not a perfect mirror of the economy day to day. That is true. It can rally in bad headlines, it can fall in good headlines, it can overshoot in both directions. But over time, businesses do not escape economic reality. Consumers matter, spending matters, hiring matters, enterprise budgets matter. If oil rises enough to pressure households and business costs, that eventually shows up somewhere. If growth slows enough, the market cannot permanently pretend that businesses are exempt from the environment in which they operate. So I prefer not to get intoxicated by elegant macro takes. I want to know whether the company has pricing power. I want to know whether the customer relationship is durable. I want to know whether the moat is real. I want to know whether management is capable. I want to know whether fear has already been amply reflected in the price. Those questions have produced much better results for me than trying to guess the exact month when a strategist's confidence will prove timely or foolish. The same caution applies to technology fear. Every generation produces people who are absolutely certain the next wave of innovation will permanently break the labor market, erase human usefulness, and turn the future into a bleak place where only intervention can save people from mass obsolescence. They speak with great confidence. They cite fast-moving companies, conference demonstrations, eye-catching revenue growth, and dramatic anecdotes. They point to one corner of the job market and generalize it across the whole economy. They use the most anxious data point they can find, as though it were a complete portrait of the future. I have heard variations of that story all my life. It is rarely wise to dismiss technological change. Technology does displace tasks. It does pressure industries. It does reorganize labor. But the loudest people in these debates consistently miss the same second half of the equation. They see what becomes easier. They see what may be automated. They see what old process may disappear. What they do not fully appreciate is how much new demand gets created when productivity rises, when costs fall, when profits improve, and when businesses find new reasons to build, hire, and expand. The destruction is visible. The creation is delayed. That delay is enough to frighten people into thinking only the first half is real. Consider software development itself. If tools make developers more productive, the lazy conclusion is that businesses will need fewer developers. Sometimes that happens in a narrow window, but often the opposite happens over time. If the return on capable talent rises, companies do not necessarily shrink ambition. They expand it, they build more products, they ship faster, they attack more opportunities, they reinvest better economics into larger plans. One of the enduring mistakes in capitalism is to assume that efficiency automatically ends demand. Very often, efficiency expands the amount of worthwhile work that can be done. That does not mean transition is painless. It means the future is usually more generative than the fear merchants admit. The same goes for industries like transportation. It is easy to tell a frightening story about trucks driving themselves, millions of jobs vanishing, and social order cracking under technological pressure. It is much harder and much more honest to look at the actual work involved, the constraints in real environments, the operational complexity, the safety requirements, the supporting tasks around the core job, and the long transition period that usually separates a laboratory capability from full economic replacement. Fear likes straight lines. Reality usually moves through messy curves. That is why I distrust dramatic declarations about the end of work. Human beings are adaptive. Markets are adaptive. Companies are adaptive. New tools do not merely remove old tasks. They rearrange the map of what becomes worth doing next. If you spend enough years in markets, you learn that optimism rooted in real productivity is usually a better guide than pessimism dressed up as sophistication. That does not mean being blind. It means refusing to let drama do your thinking for you. And that brings me back to these businesses. What I like most about this setup is not that every concern is false. Some of these concerns are meaningful. Competition can emerge. Technology can compress margins. Capital spending can disappoint. Rates can remain inconveniently high. The economy can wobble. The market can take longer than expected to reward patience. All of that is possible. What matters is whether the current prices are already reflecting a large share of those anxieties. That is the key. Investing is not about discovering a world with no risks. It is about comparing the quality and durability of the business with the price you are asked to pay while everyone is fixated on those risks. If a business is still excellent, and the price is now far more reasonable because the crowd is obsessed with headlines, that is often when future returns begin to improve. I never liked buying into universal applause. Universal applause is expensive. I prefer the moment when a stock chart looks ugly, the headlines look heavy, and the conversation has shifted from what a great company this is to what if the moat is smaller? What if the multiple was too high? What if AI changes everything? What if the macro picture gets worse? What if this is dead money for a while? Those are uncomfortable questions. They are also the questions that clear room for better long-term entry points. What separates an investor from a commentator is the willingness to live in that discomfort without losing discipline. A commentator can always move to the next segment, the next hot take, the next forecast, the next warning, the next argument about what this month or this quarter will look like. An owner cannot behave that way. An owner has to decide whether a business deserves capital. An owner has to decide whether fear is revealing a problem or simply offering a better price. An owner has to decide whether the machine still compounds. That is what I keep coming back to here. FICO still looks like a powerful language embedded in the credit system. Uber still looks like a scaled network with growing leverage and more resilience than its critics assume. Intuit still looks like a trusted convenience franchise in a task people desperately want simplified. Microsoft still looks like one of the great economic fortresses in the world, only now available without the same premium. Brookfield still looks like a patient allocator being marked down by cyclical anxiety. SP Global still looks like market infrastructure, not just a pile of data waiting to be commoditized. If I am right, then the present ugliness is not something to fear. It is the admission price, and if I am wrong, I want to be wrong for the right reasons. I want to be wrong because I carefully evaluated durable businesses and misjudged their staying power. Not because I let war headlines, oil spikes, television forecasts, and technological panic do my thinking for me. That distinction matters deeply. Most investors do not fail because they lack information. They fail because they cannot hold a coherent view when the emotional weather changes. They buy what feels safe after the revaluation. They sell what feels dangerous after the decline. They let narrative determine price in their minds instead of asking whether price now compensates them for narrative risk. The market gives that test over and over again. This is one of those times. The headlines are loud, the forecasts are confident, the fear is broad. Good companies are trading well below where the crowd loved them. Some of the best investors in the world own these very businesses, not because they enjoy short-term pain, but because they understand something simple and durable. High-quality companies do not stop being high quality, merely because the market becomes temporarily afraid of them. The real money is often made by the people who remember that, while others are busy trying to feel certain. I do not know which of these names will rebound first. I do not know which quarter will calm the crowd. I do not know which analyst note will declare that the worst is past. I do know that when great businesses are sold with the rest of the noise, you are often being given a chance that will look obvious only in hindsight. Those moments never feel comfortable at the time. That is why they are valuable.